In 1929, the stock market collapsed and pushed America into the Great Depression. Shares didn't just slide, they kept dropping until they lost about 89% over 3 years. 1 in 4 people had no job, banks went under, savings vanished, and the market didn't climb back to its 1929 level for 25 long years. Then, in 2008, the housing market cracked apart and set off the Great Recession. Markets fell 57% in a year and a half. Unemployment hit 10%. Banks needed emergency support just to stay alive. Retirement funds shrank fast. It still took around 5 years for markets to recover their old highs. But 2025 isn't tracking either of those moments. This time, stocks, bonds, and real estate are all sliding at once. Financial historians have started calling it the everything bubble because every major asset class inflated together. And when all of them break at the same time, there's no safe corner left. Think about it this way. We're not facing something brand new. We're basically sitting in 1928 again, right before everything fell apart. The difference now is that the tools used to rescue the system in 1929 and in 2008 aren't available anymore. The Federal Reserve can't cut rates to zero because rates are already close to the floor. It also can't flood the economy with more printed money because the last round delivered the worst inflation in 40 years. And the government can't step in with massive bailouts because it's carrying $36 trillion of debt and rising. Here's why that matters. Nearly every major financial signal is flashing bright red. The danger window runs from November 2025 to June 2026, and the collapse ahead is set to erase more wealth than any previous financial disaster. This isn't about guessing, it's simple math and basic market structure. To see why 2025 stands apart, you have to understand that we're dealing with not one bubble, but 3 inflated markets at the same time. That combination has never happened in recorded financial history.
The Great Depression, and in 2000, right before the dot-com collapse that wiped out roughly 78% of the Nasdaq's value. After hitting those extreme levels, both markets cracked within months. What makes 2025 even riskier is how top-heavy the market has become. 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, now make up about 30% of the entire S&P 500. If those 7 names slip, the whole index goes with them. Nothing like this has shown up since 1929, when a few industrial giants held the market up until they couldn't anymore. Even during the 2000 tech bubble, the weight of the big names wasn't this concentrated. And then there's Nvidia, which shows how stretched things have gotten. The stock trades at a price-to-earnings ratio above 65. That means investors are handing over $65 for every single dollar the company earns. Nvidia's market value has pushed past $3 trillion, and that number alone says a lot. It now sits above the entire German stock market, even though Germany is the 4th largest economy on the planet. People try to justify this as some kind of forward-looking confidence, but it's not grounded in reality. It's speculation, fed by non-stop talk about artificial intelligence, the same type of hype people got swept up in back in 1999. Everyone back then insisted the internet would reshape life. They were right about the long game, but the stock prices of that era were built on wishful thinking, not real earnings. That mistake is repeating itself now with AI. The excitement is real, but the pricing is fantasy. And that's only the first bubble. The second one is housing, and this one is even more stretched than what we saw in 2008. As of November 2025, home prices sit about 50% above their long-term relationship to income and rent. At the 2008 peak, the gap was about 35%. If you do the math, today's disconnect from fundamentals is roughly 43% bigger than the bubble that helped trigger the Great Recession. Think about that. The crisis that required trillions in emergency support, wiped out major banks, and almost toppled the global financial order came from a 35% overshoot. Now we're at 50%.
And most people shrug because they've gotten used to insane prices. After 15 years of inflation and low supply, the abnormal started to feel normal. But residential real estate isn't the whole picture. Commercial real estate is dealing with a deeper, slower collapse. Offices across the United States are sitting empty, with national vacancy around 45%, and no sign of meaningful recovery as remote work becomes a long-term shift. San Francisco's commercial office vacancy rate is roughly 35%, and it's been stuck there as companies downsize or relocate. Many of these buildings were bought or refinanced when interest rates were near 3%. Now those loans are rolling over into a market where refinancing costs 7 to 9%. The buildings don't produce enough income to support debt at those rates. That gap turns into defaults, bank write-downs, and a growing chain of failures that will look a lot like the 2008 subprime mess, except this time the collapse is centered in commercial properties instead of homes. Then there's the third bubble, the one that makes 2025 unlike any past financial stretch. The bond market, the supposed safe corner of the economy, is cracking at the same moment stocks show stress. In 1929, bonds held steady while stocks fell apart. In 2008, Treasury bonds surged because investors fled to safety. But in 2025, bonds are sliding at the same time as stocks because the government keeps issuing debt at a pace the market can't handle. Federal debt has climbed past $36 trillion, roughly 125% of GDP. The last time the United States carried a debt load like that was at the end of World War II, but the situation then was different. After the war, America stood alone as the only major industrial power with intact infrastructure and unmatched economic strength. Today, the country faces competition from economies with lower debt and better balance sheets. The annual interest bill on this $36 trillion tile has grown past $1.2 trillion a year. That single expense now outweighs defense spending and even Social Security, turning interest payments into the biggest item in the entire federal budget. This isn't a small warning sign. It's a shift in the foundation of how the
System works, happening at the same time as bubbles grow in tech, housing, and commercial real estate. When interest costs grow bigger than everything else the government pays for, it gets boxed in. It can slash spending fast, which drags the country into a recession. It can raise taxes hard, which ends in the same place. Or it can print money to cover the bill, which pushes prices up and weakens the currency. No matter which path it takes, the outcome is trouble. And when those interest costs alone match the entire GDP of Mexico, the warnings are bright red. This is what people call the everything bubble. Stocks sit at levels that have only appeared twice before, both right before major crashes. Housing prices look even more stretched than in 2008. Bonds, once treated as the safest place to hide, are falling because the debt behind them keeps growing past what can reasonably be paid back. The situation in 2025 lines up with 1929 so closely that it feels like watching an old movie remake with the same script. Back in 1929, stock prices soared far beyond anything considered normal. The Dow Jones Industrial Average traded at a price-to-earnings ratio of 33, which at the time looked impossible to justify. In 2025, the S&P 500 sits around 28 times earnings, almost the same tension point. People in 1929 believed electricity, the radio, and the automobile rewrote the rules of the economy. They thought old measures didn't matter anymore. The phrase, "this time is different," spread everywhere. In 2025, artificial intelligence plays that role. Many argue it will reshape everything and make traditional valuation limits irrelevant. Margin debt in 1929 hit extremes as people from all kinds of jobs borrowed money to chase fast profits. Stories floated around about everyday workers getting rich in days. In 2025, the leverage problem runs even wider. Margin debt as a share of GDP is back near those old highs, but now risk hides in more places. Retail traders pile into options. Some use credit cards to buy stocks. Companies borrow cash to
buy back their own shares at high prices.
Debt sits inside derivatives and complex financial products most people never look at closely. Wealth imbalance also played a major role in 1929. The top 1% controlled about 25% of all income, which meant the economy leaned on a tiny group of wealthy households to keep spending. When they pulled back, everything sagged. In 2025, the numbers are even sharper. The top 1% now holds around 32% of total wealth. The top 10% accounts for about 70% of consumer spending. If those groups cut spending because their portfolios fall, demand dries up and the broader economy stalls. And one important detail makes 2025 tougher than 1929. In 1929, most Americans weren't in the stock market at all. Only about 10% of households owned stocks, so 90% of the country didn't feel the crash directly. Today, far more people have retirement accounts, index funds, and exposure through jobs tied to asset prices. A downturn hits a much bigger share of the population, and it hits fast. They dealt with unemployment and falling prices later on, but the first shock didn't wipe out their money because most of them didn't keep savings in the stock market. In 2025, the situation looks completely different. Around 58% of American households hold stocks in one form or another, either on their own or inside retirement plans like 401ks and IRAs. So when the market takes a hard hit, it instantly cuts into the retirement funds of more than half the population. There's no cushion left, no delay. The damage hits fast and hits everyone at once. Back in 1929, the banking system was split into thousands of tiny banks, and none of them had federal insurance to calm people down. When the crash happened, people rushed to pull out their deposits, and the banks simply collapsed. With no deposit insurance, a failing bank didn't just close its doors, it erased the savings of regular families. In 2025, we have FDIC insurance that promises to protect up to $250,000 per account. But the FDIC fund holds roughly $125 billion while covering about $100 trillion in deposits. If several major banks fall together, that fund won't come close to covering the losses. The only
way to make depositors whole would be for the government to create massive amounts of new money, and doing that would push the currency into heavy inflation. So people either lose their savings through bank failures, or they lose them through inflation eating everything away. There's no clean exit. The Federal Reserve in 1929 still had a reputation to lean on. It had been around only since 1913, about 16 years, and people hadn't yet watched it cycle through decades of mistakes. The Fed could have dropped interest rates faster back then, but the leadership didn't grasp the scale of the problem until it was already too late. In 2025, the Fed carries the weight of the last 15 years, and none of it looks good. After 2008, they pumped the system full of cheap money through quantitative easing. They kept rates down far longer than they should have, feeding the growth of an everything bubble. Then they reversed course too hard in 2022 and 2023, hiking rates fast enough to push inflation higher while also risking a deep economic stall. Trust in the Fed has faded. And worse than that, the tools they relied on in past crises no longer work the same way. The 2008 financial crisis offers a more recent example of how quickly things can fall apart, and it lines up closely with the pressure building in 2025 and 2026. In 2008, it started with subprime mortgages, loans given to borrowers who couldn't actually afford them. These loans were bundled into complicated securities and sold everywhere. When home prices finally stopped rising, borrowers couldn't refinance, defaults climbed, and the problem spread through the global financial system. Banks turned out to be far more leveraged than anyone admitted, and the mortgage-backed securities they held were basically worthless. In 2025, subprime lending never went away. It just changed labels. You can see it in long auto loans stretched to 84 months with high interest rates given to people with weak credit scores. You see it in record credit card balances paired with average rates above 21%. You see it in student loans that add up to $1.77 trillion, debts that a large share of borrowers will never realistically pay back. The same pattern is there again. Too much debt resting on people who can't handle it, only now it's spread across nearly every corner of personal finance. Corporate debt has blown up from about $2 trillion in 2008 to more than $10 trillion today. Companies spent years borrowing cheap money so they could keep buying their own stock. and that pushed their balance sheets to the edge. Back in 2008, most of the dangerous leverage sat inside housing and mortgage-backed securities. Banks such as Lehman Brothers carried leverage of roughly 30 to 1. For every single dollar of real capital, they held $30 in assets that looked solid until they slipped just a few percent. Once those assets dropped around 3%, Lehman was finished. It went under in September 2008 and set off the worst financial panic since the Great Depression. And by 2025, the system faces pressure on many more fronts. Now leverage isn't boxed into one place. It's spread across almost every corner of finance. The derivatives market alone sits above $600 trillion in notional value, which is about 10 times global GDP. Most of these contracts are interest rate swaps or credit default swaps. Both can blow up fast if rates swing too hard or if a wave of major corporate failures hits. Everything is tied together, so one collapse can trigger a chain of failures that feeds on itself. Once that chain starts, it's almost impossible to contain. In 2008, the Federal Reserve still had power to fight the crisis. When things first broke, interest rates were at 5.25%, so the Fed could cut all the way down to zero. That move encouraged more borrowing and spending and helped slow the panic. The Fed also launched huge rounds of quantitative easing, buying massive piles of treasury bonds and mortgage-backed securities. Its balance sheet jumped from about $800 billion before the crisis to around $4 trillion by 2014. This huge injection of money helped stop a total meltdown, but it also built the bubbles that are now cracking in 2025. Today, the Fed has far less room. Interest rates in 2025 are already low, so cutting them again offers only a tiny benefit. And if the Fed cuts too fast, it risks pushing inflation back up, even though inflation was only recently dragged under control after painful rate hikes. But if the Fed refuses to cut, the economy risks sliding straight into a deep depression. Quantitative easing is stuck too. The balance sheet is already above $7 trillion after repeated rounds of QE following 2008 and again during COVID. Printing more money is possible, but everyone now knows what happens. The inflation surge from 2021 to 2023, the worst in 40 years, proved that endless printing destroys the dollar's buying power. So the Fed sits in a trap: print and wreck the currency through inflation, or don't print and let deflation tear the system apart. The tools that saved the economy in 2008 have been used so often that they no longer work. The government doesn't have much bailout space left either. In 2008, the government could borrow heavily because federal debt was still near 67% of GDP, which looked manageable at the time. That's why programs like TARP, authorized at $700 billion to buy toxic assets, were possible. More programs pushed the total bailout cost close to $2 trillion. People hated it, but financially the government could still absorb it because it had room to borrow. Now that room is gone, and the system faces stress without the same escape routes. In 2025, the federal debt sits at 125% of GDP, and the government is running trillion-dollar deficits with no sign of relief ahead. It's clear the government doesn't have another $2 trillion lying around to rescue failing banks or large corporations. And if officials try to raise that money by borrowing, bond markets will push back fast. Rates will jump, which will make an already heavy debt load even harder to manage. The kind of bailout that kept the system alive in 2008 simply isn't an option in 2025. The global backdrop also makes this moment far harsher than 2008. Back then, China was expanding rapidly and helped steady the world by boosting its own spending and buying massive amounts of commodities. Europe had problems, but it wasn't trapped in the same debt situation the United States faced. The G20 still worked together well enough to coordinate stimulus programs. In 2025, none of that is true. China is dealing with its own financial troubles, including a collapsing real estate sector, local government debt exceeding $13 trillion, and a shrinking population that's already dragging on growth. Europe is struggling with an energy crisis, aging demographics, and political fragmentation that keeps it from responding decisively.
There's no major economy ready to lead, and with geopolitical tensions rising, cooperation is basically off the table. When the next shock hits, each country will focus on its own survival instead of trying to craft a shared solution. For more than 70 years, the most reliable warning signal for recessions has been the inverted yield curve. Every time short-term rates have climbed above long-term rates since 1950, a recession has followed, and there hasn't been a single false alarm. The curve flipped in July 2022 and stayed inverted for 27 months before returning to normal in September 2024. History shows recessions usually begin 3 to 12 months after the curve normalizes, not during the inversion itself. That puts the danger zone between October 2024 and September 2025. We're already inside that window, and the one indicator that has never been wrong is telling us a downturn is close. Consumer debt is also flashing red. Credit card balances have passed $1.14 trillion, the highest nominal level ever recorded. The average household now carries about $6,800 on cards, with interest rates running between 21% and 28%. Delinquencies, borrowers who are 90 days or more behind, are up to levels last seen in 2011. This matters because consumer spending makes up 68% of the entire U.S. economy. When people can't borrow anymore and have to start paying down debt, spending drops. And once spending drops, the whole economy slows. Right now, consumers are stretched to their limits. They can't keep driving demand the way they have over the past decade. The commercial real estate problem is also building. It's moving slowly for now, but it will speed up through 2025 and 2026. More than $2 trillion in commercial mortgages will come due and need refinancing. Most of these loans were made when rates were around 3%. Today, rates are in the 7 to 9% range. A building that barely broke even at 3% interest can't survive at 8%. Many of these properties
will slide into distress or default once the refinancing wave hits, adding another heavy strain to an already fragile financial system. The numbers don't line up anymore. In a lot of cities, building prices have sunk by 40 to 60%, and buyers aren't fooled. They know these places can't cover the debt with today's interest rates. When the loans come due and owners can't refinance, most won't fight it. They'll walk away and dump the keys on the lender. Regional banks that hold these mortgages will eat losses big enough to wipe out their capital. What we saw in 2023 wasn't some freak moment. Those failures were a preview, and almost no one paid attention. Silicon Valley Bank went under in March 2023, becoming the second largest bank failure the country has seen. Signature Bank went down that same week. First Republic Bank fell in May 2023 and ended up in JP Morgan's hands after a huge loss that the FDIC had to absorb. New York Community Bank was hanging by a thread in January 2024. And keep in mind, all of this happened before the economy even slipped into a recession. Once a real downturn hits and defaults jump, the situation gets ugly fast. Dozens of regional banks won't survive. The FDIC's $125 billion fund will burn out in a couple of weeks. Then the government will be forced to print money to keep depositors whole, and that will hammer the value of the currency. There's also the market imbalance built around just 7 giants, the so-called Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Google parent Alphabet, Meta, and Tesla now make up about 30% of the entire S&P 500. Nvidia alone, trading at a price-to-earnings ratio north of 65, represents roughly 7% of the index by itself. If Nvidia's earnings slip, or if the whole AI excitement cools off, that stock could fall 50 to 70% without much effort. And because it's such a huge slice of the index, that kind of drop would drag the broader market down immediately. The risk tied to this small cluster of companies is unlike anything in earlier periods. When the downturn hits, these 7 will be the first to crack. And because they carry so much weight, the slide will be sharper and faster than what people expect. Insider selling is another warning sign. The volume is at levels that have historically shown up right before big market breaks.
Executives always see the truth before anyone else. They know how real earnings look, what the next quarters actually hold, and where the weak spots are. When they start offloading big chunks of their own shares, that's not a random decision. It's them saying the price is too high to trust. Jeff Bezos sold more than $13 billion of Amazon stock through 2024 and 2025. Mark Zuckerberg has been unloading billions of Meta shares. Nvidia leaders were selling even as the stock was setting new records. The same pattern showed up in 1929 and again in 2000. Insiders recognize when valuations are detached from reality and they exit before the fall. And then there's Warren Buffett. The most successful investor alive is sitting on more cash than ever. Berkshire Hathaway now holds over $325 billion in cash, the biggest pile in its history, both in size and in percentage of total assets. He's been trimming positions, including cutting down his large Apple stake, while shifting money into treasury bills. He doesn't do that without a reason. He explained his position in simple terms. Prices are stretched, and he can't find anything worth buying. His usual gauge, the Buffett indicator, compares the entire stock market's value to GDP. Right now, it sits near 185%. He has said many times that anything above 120% signals trouble. At 185%, the warning is hard to ignore. So the most respected investor on the planet is holding cash and waiting, convinced a downturn is already forming. Unemployment adds to that picture. It dropped to 3.4% in early 2023, but climbed to 4.1% by October 2025. Sure, 4.1% doesn't look scary on its own, but the direction is what matters. Economist Claudia Sahm created the SAM rule, which tracks the 3-month average of the unemployment rate. When that average rises by 0.5 percentage points above the lowest point from the past year, the economy is
considered to be in a recession. This measure has nailed every recession since 1970 without a single false alarm. As of October 2020, the numbers were sitting right on the edge of that trigger. Once unemployment begins moving up, the process tends to feed on itself, because layoffs push companies and workers into more stress, which leads to further cuts. Debt problems show the same pattern. Auto loan delinquencies have shot up to levels last seen during the 2008 crisis. Around 7.5% of auto loans are now 90 or more days past due, the worst since 2009. New car payments average more than $740 a month, and many loans run for 84 months. It's the same subprime setup everyone remembers, just wrapped in softer language. People who clearly can't manage these payments are getting approved anyway. When they fall behind, they lose the car, and that often leads to losing the job as well. One missed payment can knock over several parts of a person's life, and it becomes a sign of deeper pressure building in the consumer economy. Student debt tells a similar story. After payments restarted in October 2023, following a 3-year freeze, delinquency rates jumped. Total student debt sits around $1.77 trillion, spread across roughly 43 million borrowers. A growing number are deciding to stop paying entirely because the balances are so large they don't see a path out. That choice pulls more than $100 billion each year out of spending that would otherwise go into housing, family plans, or basic purchases. The very group that should be pushing demand and growth is instead stuck paying for degrees that often don't provide a financial return. Geopolitics in 2025 adds even more strain. The wars in Ukraine and the Middle East continue. China keeps raising the threat level around Taiwan, and global trade is splitting into competing systems. Any one of these could flare up and hit energy, food, or key supply chains. A sudden jump in oil prices, something like what happened in the 1970s, could push the world into stagflation, a mix of rising prices and shrinking growth that's tougher to handle than a normal recession. Markets react badly to uncertainty, and the uncertainty in 2025 is as intense as anything seen since the 1970s.
Commercial real estate trouble has already started to show up at big institutional owners. In 2024, Brookfield Asset Management let 2 Los Angeles office towers go into default. Blackstone, the biggest commercial real estate owner in the world, has been dealing with waves of redemption requests from investors who want their money back. These are not small operators. These are the groups that usually see problems early. When they walk away from properties, it tells you the numbers don't work anymore with today's interest rates. And when the most experienced owners start defaulting, it's a sign the core assumptions of the market have stopped holding together. Through 2025 and 2026, more loans will mature. Every round of expiring mortgages will pull more buildings into default. That will hit banks, especially the ones already stretched thin. Losses pile up, more loans go bad, and some banks eventually fail. There won't be a single moment where everyone agrees the crash started. It won't look obvious at first. It will show up as something that seems small enough to handle. Maybe a big tech company misses earnings. Maybe a regional bank collapses and the size is worse than expected. Maybe a geopolitical dispute gets worse. Maybe debt ceiling talks fall apart again. The exact spark doesn't matter much because the whole system is so weak that almost any shock can push it over. What matters is the chain reaction that comes after. One break sets off the next, and each failure adds weight until the financial system feels like it's falling all at once. If NVIDIA or another member of the Magnificent Seven reports weak numbers or lowers expectations, trading algorithms will start dumping shares right away. NVIDIA could lose 10 to 15% in a single day. Since it makes up around 7% of the S&P 500, that alone drags the index down about 0.7%. But the bigger issue is the shift in sentiment. If people start doubting the AI story that pushed valuations higher, they'll question everything tied to it. Microsoft, Apple, Amazon, Google, Meta, and Tesla would likely slide just because investors fear the same cracks apply to all of them.
In a few days, the whole Magnificent Seven group could be down 20 to 30%. That drop would pull the broader market lower by about 6 to 9%. And once stocks sink that far, margin calls kick in. Margin calls are what turn a dip into a real collapse. When people buy stocks with borrowed money and those stocks fall, brokers demand more collateral. If the investor can't produce cash, the broker sells the position to protect the loan. Those forced sales push prices down more, which triggers more margin calls, and the spiral keeps going. That same pattern helped drive the 1929 crash. In 2025, margin debt as a share of total market value sits close to the levels seen back then. Once the sell-off starts, it won't feel slow. It will hit hard and keep moving. Big institutions that handle pensions, endowments, and sovereign wealth funds follow strict risk rules. When markets drop past certain limits, they have to sell. It's not a judgment call, it's automatic. A 20% decline sets off those systems and forces more selling to limit losses. When these players unload large positions, the pressure on the market gets stronger and the slide speeds up. Tech companies that swelled during the boom start cutting deep, dropping 10 to 20% of their teams as soon as profits slip. Finance firms tied to sinking markets follow with their own layoffs. Consumer discretionary businesses see customers pull back, so they shut stores and cut anyone they can. In the first 3 months after the crash begins, unemployment could jump from 4% to around 7 or even 8%. By the 6th month mark, 10% looks like a real possibility. After a year, 12 to 15% unemployment isn't far-fetched, because once the failures start rolling through the system, they don't stop quickly. The Federal Reserve faces a problem with no good answer. They can slash interest rates and bring back quantitative easing to try to calm everything down, but doing that risks firing up inflation again before it's been fully controlled. People still remember 2021 to 2023 when inflation hit 9% and wiped out buying power. If the Fed prints trillions again, the dollar could take a hit and inflation could come back worse
than the last time. The other option is to let the crash run its course. That route means unemployment at depression levels and a long stretch of economic stagnation that could last a decade. There's no comfortable middle option. The tools that helped in 2008 don't work in 2025 because they've already been used too many times, and everyone knows the price that comes with them. For a regular American with a 401k or IRA, seeing their retirement savings fall 60 to 70% will feel like more than a financial loss. Someone who worked 30 years to save, who has $600,000 tucked away, could watch it sink to $200,000 or even less. That's not a normal downturn. That's the collapse of the future they planned. They can't retire on that. They'll need to work another 10 to 15 years, and that's assuming they even keep their job through the recession. People already retired have it worse. They rely on withdrawals to pay the bills, and that forces them to sell investments at the lowest point, locking in losses they won't recover. Watching decades of savings vanish creates a level of stress most people aren't prepared for. In 2008, retirement accounts fell hard but came back after about 5.5 years. People who held on eventually recovered. In the coming crash, a full recovery could take much longer, if it ever happens. Japan's market fell in 1990 and didn't return to those highs until 2024, 34 years later. A whole generation of investors in Japan never saw their wealth return. Something similar could happen in America if the crash is sharp enough and the rebound takes decades. Housing losses will trap millions in homes they can't sell without taking hits they can't afford. Young workers face an especially rough start. Graduates in 2026 and 2027 will enter a market with almost no entry-level jobs. Companies won't be hiring, and the few roles that show up will draw hundreds of applicants. This group will begin their careers 5 to 10 years behind where they should be, and that delay will drag down their earnings for the rest of their lives.
People who finished school during the 2008 recession ended up earning less for decades, and that was during a smaller downturn. The hit coming in 2025 will cut deeper and stay longer. When spending drops and credit dries up, small businesses won't stand a chance. The local restaurant on the corner, the tiny clothing shop, the family-run repair place, all of them will get squeezed until they shut their doors. Hundreds of thousands will disappear. Big corporations will still be standing because they can tap capital markets, but even they'll shrink. After the crash, the whole economy will lean even harder toward giant firms while small businesses fade into the background. That shift means less competition, fewer fresh ideas, and a slower economic pulse. Social programs will be pushed past their limits as unemployment spikes and tax revenue sinks. The government will have people begging for help at the exact moment it can't afford to offer much. Cuts will land even while demand rises. That turns the downturn into something worse, a humanitarian mess where seniors, disabled people, and the unemployed lose support right when they need it most. History shows what follows. When economies fall apart, politics get ugly. The 1930s proved that across Europe as desperate people backed extremist groups. Weimar Germany's hyperinflation cleared the path that later carried Hitler into power. And the US isn't protected from that kind of fallout. When people lose their savings, their homes, or their sense of stability, they look for someone to blame and someone who claims to have extreme answers. The 2025 crash will push American politics into territory we can't map out yet, but it's hard to imagine it leading anywhere calm. The reason 2025 stands out as worse than 1929 and 2008 together is simple. It combines all the problems at once. We have stock bubbles like 1929, debt bubbles in housing and credit like 2008, and a government debt bubble that neither past crisis had to deal with. These three pressures are hitting at the same time. In 1929, the stock market collapsed, but only a small slice of the population was directly involved. In 2008, housing collapsed, but the government could still borrow money to prop up failing banks. But now the U.S. debt is far too high.
Banks and the Fed could print cash without sparking runaway prices. In 2025, everything is breaking at once, and the usual tools don't work. The Fed can't push rates back to zero because inflation is still too high. They can't flood the system with new money because the last round gave the country its worst inflation in 40 years. And Washington can't rescue everyone when it's already sitting on $36 trillion in debt. The 12 warning signs, including the inverted yield curve and even Warren Buffett piling up cash, aren't guesses. They're real, happening right now in front of us. The yield curve, which has predicted every recession since 1950, is signaling the downturn is close, maybe 3 to 9 months out. Regional banks are already failing, and more stress is building underneath the surface. Commercial real estate keeps slipping, and nothing suggests it will stabilize soon. Consumer debt is sitting at record levels, and late payments keep rising each quarter. Unemployment is moving up, not down. People on the inside are unloading shares at a pace we usually see right before major sell-offs. Every major signal that traders watch is turning red at the same time, and none of them look temporary. The timing isn't a mystery. The yield curve is set to normalize in September 2024, and recessions tend to follow that shift by about 3 to 12 months. That places the danger zone somewhere between December 2025 and September 2026. Those years also line up with the biggest wave of commercial mortgage refinancing in decades. At the same time, credit card defaults are already speeding up, which means the pressure is building long before the main shock. Any spark could set it off, and once the first break happens, the rest will follow fast, because the system is already stretched thin. This isn't a guess or a dramatic warning. It's the same framework people used to spot the trouble that hit in 1929 and again in 2008. The setup now looks even harsher because debt is heavier, valuations are higher, and policy options are fewer.
If the crash hits the way the numbers suggest, stock markets won't just dip. They could fall 65 to 80% from their highs. That would be sharper than the 19 and 29's 89% collapse because it would happen faster and hit more corners of the market at once. Bonds, usually the safe place, could fall 35 to 50%, something we didn't see in earlier crashes. Real estate might drop 40 to 60%, deeper than the hit in 2008. Job losses would push unemployment past 15%. And getting out of it won't be quick. The rebound after 2008 took around 5 years, but this time the Federal Reserve doesn't have the tools it once had, and the government can't borrow like it used to. That's why a recovery could stretch 10 to 20 years or longer. The everything bubble earned its name because everything is overvalued at the same time, and when it unwinds, everything falls together. We like to think the historic crashes in textbooks belong to another era, that we're too informed to repeat them, but the same math that drove those disasters is active again, only with larger numbers and tighter limits. When the break comes, it will surprise the people who assumed it couldn't happen again. The debt is too large to service, the assets are priced too high, and the policy tools are already spent. The fall is coming. The only thing left is whether you're ready for it when it shows up.